Welcome back to Outside Views, and today we have to talk about the number that should shock every single person who cares about the UK economy. We're almost 6 years past the official departure from the European Union, and the economic reckoning is here. And the number I'm talking about is 253 billion euros. That is the staggering sum that the UK economy could be richer by today had it remained inside the single market. And my personal view is that this figure is not just a statistic. It's the cash value of a colossal self-inflicted national mistake, and it represents a massive missed opportunity for every worker, every business, and every public service. The initial euphoria of the referendum is long gone, replaced by a deep grinding economic illness. And the mood has shifted so fundamentally that 57% of the public recently expressed a preference for rejoining the European Union, although it wouldn't be a real rejoining, but I explained this a lot of times already. Because the reality of the last 8.5 years has been two things: years of political chaos surrounding the terms of exit, and a conclusive, measurable economic disaster. A crucial study from the US-based National Bureau of Economic Research has meticulously calculated the damage. They conclude that the decision has cost Britain around 6 to 8% of its economic output. And when measured against the country's GDP from last year, that translates directly into the headline figure. The economy could be up to 253 billion euros higher today. And this is not a temporary dip. This is a structural generational loss that is draining the nation's wealth. And the other data points arising from this rigorous comparison with similar non-Brexit economies are equally devastating. The investment that fuels future prosperity is down by a massive 12 to 18%. Productivity, the measure of national efficiency, has fallen by 3 to 4%. And even the number of people employed is lower by 3 to 4%. And these are the core metrics that determine a country's long-term health, and every single one has been compromised. And I hear the defenders of the decision arguing that the COVID-19 pandemic and the subsequent energy crisis are the real culprits. They point out that since the 2016 referendum, the UK's overall GDP has grown by 10.5%, slightly more than Germany's 7.9%. But that argument is willfully misleading and fundamentally misses the point. The NBER economists use a sophisticated technique to filter out these global shocks. They created a synthetic Britain, a statistical model composed of 33 comparable countries, from the US to Germany and Japan, weighted to perfectly match the UK's pre-Brexit growth trajectory. And when they compare this synthetic model to the actual UK after 2016, the difference is 6 to 10% in favor of the model. And this difference, this gap, is the unavoidable measurable cost of Brexit. And the cost goes beyond lost growth. It has directly inflated the national debt. The governor of the Bank of England, Andrew Bailey, recently pointed out that the decision has directly driven up government borrowing. His central bank calculated that if the UK had remained in the EU, the national debt would be around 82% of GDP today. Instead, it stands at 96%. And that 14 percentage point difference means the UK is currently struggling under a debt burden that is an astonishing 443 billion euros higher than it should be. And that is a massive difference that translates into higher taxes, less money for public investment, and a deeply compromised fiscal future. And this debt is not the result of a global war or a financial crash. It's the result of a self-chosen trade barrier. The impact on individual businesses is perhaps the most tragic evidence of all. The US economists meticulously analyzed corporate data, looking at the difference between firms highly integrated with the EU, those that exported, imported, and employed EU nationals heavily, versus less integrated firms. And the results are stunning. Before the referendum, the heavily integrated firms saw their investment growth outpace the less connected firms. After the referendum, that trend violently reversed. From 2017 to 2023, the investment growth of the EU-dependent firms was on average 1.7 percentage points lower every single year compared to their own pre-referendum trajectory. Cumulatively, this results in an 11.6 percentage point drop in investment growth for the most productive segment of the economy. And this is not a political theory. This is the death of corporate ambition documented in a balance sheet. And the same negative trend is seen in employment. The growth in employee numbers at EU-friendly firms, which had previously outpaced other companies, slowed to an average of 0.5 percentage points less than other businesses afterward. And by 2023, the cumulative loss amounted to 3.4 percentage points of potential job growth. And even the revenue growth was harmed by an estimated 2.4 percentage points cumulatively by 2023. And this evidence clearly shows that the most integrated, most dynamic and most productive parts of the UK economy were the ones that took the hardest and most sustained hit. Industries like manufacturing, wholesale and retail trade and the financial services sector with banking and insurance were hit the hardest because they rely on frictionless access to the single market. And when you look at the international rankings, the picture is one of relentless decline. In terms of overall economic growth, the UK is barely scraping into the second percentile of its 33 comparable nations, performing better than only 3 of those countries. In terms of business investment, it performs even worse, falling short of that minimal goal. And while the development of employment and productivity is slightly better, the UK still falls into the worst 30% of comparable nations globally. And this confirms the sentiment I've held all along. The country is demonstrably falling behind its peers. The political response to this economic disaster, embodied by the Chancellor's latest budget planning for 2026, feels inadequate and in many ways painful. Faced with a massive structural deficit and an inflated debt pile, the government is resorting to measures that are likely to constrain the working population even further. The decision to freeze the income tax bracket thresholds until 2031 is a stealth tax increase that will push people with rising wages into higher tax brackets, a phenomenon sometimes called fiscal drag. They are raising taxes on property and capital gains and hiking duties on sugary foods, tobacco and alcohol. And they are even letting a 15-year freeze on fuel duty expire at the end of 2026, which means the tax will immediately rise with inflation. And despite all these measures, the UK is still projected to take on 157 billion euros in new debt in 2026. And this is without the kind of massive dedicated special funds for infrastructure and climate protection that other major economies have launched. The Bank of England Governor Andrew Bailey gave a very clear-eyed assessment of the future. He believes that while trade will eventually adapt and the negative effects won't last forever, the negative effects will continue to prevail for the foreseeable future. Well, foreseeable future is not forever, but we know what happens if banks say foreseeable future, if economy says foreseeable future. And there is no quick fix, no magic trade deal on the horizon that can replace the size, scope and ease of the single market that was willingly abandoned. The 253 billion euro figure is more than just a calculation of what was lost. It's a forecast of the future opportunity cost. And it's a heavy reminder that the long-term structural damage from this decision is now baked into the economy, burdening the country with high debt and low investment for years to come. The UK is not just smaller than it was, it has chosen a path that makes the future significantly harder and poorer than it ever needed to be.